All right. It's Friday, September 1st, and we're back with another market update. I am Tori, CEO and co-founder of Equi, and I have with us today Itay, our Chief Investment Officer. Itay, a lot's happened. It's been another eventful month in markets. Are you ready to tell us what you're seeing?
Yeah, and it has been indeed. Last time we spoke about um, the ongoing deficits and interest payments, and coincidentally, a week after that, the U.S. credit got downgraded. So I guess somebody else saw what we were seeing. Um, but again, another month that is very eventful, where the markets actually peaked around end of July, early August, and have fallen, but then had a sharp recovery in the last week of August or so. So we'll look at somewhat of the data, and we'll try to figure out where we're going from here. And today will be a labor market special, as September 1st has been the official jobs number data that came out. And a lot is going on with the labor market. So we'll take a deep dive into that.
Great. I'm looking forward to it. The theme last time we spoke was look at the data, stay rational, don't give in to the FOMO. Do you have a theme for us this week?
Well, the theme is jobs. So we're trying to figure out, okay, let's look at these historical cycles, how things have played out in the past, to try to get the most educated guess that we can of how things may look like going forward. I don't actually think this cycle is as different from others, with one big caveat that we'll touch into later in the call. So, they say the when you hear the sentence, "This time is different," you need to turn around and run out of the room. However, with that big caveat, I will say that there is something in this cycle that is actually different. It's history doesn't necessarily repeat itself exactly, but it sure rhymes. So there's a lot of rhyming going on, but there's some things that are different this cycle.
Well, let's dig into it. What you got for us?
What I think is the most interesting part of what's going on is that we're seeing the first evidence, really over the past few weeks this cycle, that the labor market is finally starting to crack. What the Fed has been wanting to do, they wanted to create some more slack in the labor market. And we're seeing the first real evidence of that happening. So this week, we've had, actually on August 29th, we've had a huge miss in what's called the JOLTS data. So JOLTS is something we look at, which basically looks at the total amount of job openings in the United States. Very important number, because the Fed looks at it even more so than they do the official NFP numbers, non-farm payroll numbers that were released today, even though the market typically takes NFP more seriously. Because in a way, this is a leading indicator. What it shows you is not necessarily how many jobs are added or subtracted from the economy. What it's showing you is the total number of open positions out there. So what's really, really interesting about this miss, is that economists expected the economy to really show 9.5 million job open positions in the country, but we only got 8.8. So it's really one of the largest. I believe it's actually the third largest miss on record in the history of this entire data set. And it shows that the labor market has decelerated quite a bit over the past month. So what you can see here is the survey, which is in purple, versus the real numbers that come in blue. So you can just see the magnitude of the miss that took place this week, which interestingly enough, the market celebrated and had a very positive response to.
Yeah, I mean, looking at these two, the survey data and the actual JOLTS data, you can see they're incredibly tightly coupled. So what does it tell us when the actual data is so far diverged from the survey results?
Right. It just means economists missed the mark this time around, and the labor market is decelerating faster than they expected. In addition to that, today we had the official unemployment data. And even though the headline number showed, a little bit under, I think around 180,000 jobs added, what was really interesting is that, unlike prior times, the unemployment rate jumped quite a bit. So the unemployment rate jumped in September from 3.5 to 3.8%. And again, a pretty big jump in the unemployment rate. Some of it has to do with labor market participation rising. So more people are entering the workforce looking for jobs. But what's really interesting when you dig into the data itself is despite the fact that you're seeing a headline number of almost 200,000 jobs added, when you look at full-time jobs versus part-time jobs, you can see that over the last 2 months, there's been a negative number of almost 670,000 of full-time jobs that were added. So the labor market is actually decelerating very quickly over the last few months.
What's the time frame that we're looking at there?
Yeah, so this is COVID, the 2020 big marks, obviously. Then the economy kind of reaccelerates post COVID, and then we went through this period and basically pretty stagnant period of time in 2023, and now things are starting to kind of decelerate again. When you're breaking it up into full time and part time, I think this is one of the most interesting parts. There is that the headline numbers still showing some positive number out there, but the reality is that, when you're losing 670,000 full-time job and you're adding 1 million part-time job, that's typically not a good sign for the economy, right? These are obviously not the same quality type of jobs. So it's not just the quantity, but it's also the quality of the jobs that are getting added.
And so when you think about it, I mean, this is looking across a lot of different industries, right? And so if you're a business and well, we need additional help, we can't afford to open a full-time headcount, maybe we'll do something that's project-based or just seasonal. But if you're someone looking to re-enter the workforce, obviously it's not what you're looking for necessarily.
Right. But it's potentially what the Fed has been looking for, as the Fed has been looking to ease some of these wage pressures, because wage inflation is one of the key drivers of services. And as the Fed has made it very clear, they want to ease inflation. So a lot of it comes at the expense of the labor market, which is historically why you typically get a recession, because the Fed has to induce a recession in order to stop inflation. That's historically what happened. What's really interesting too this year is that as the new data comes in, they have revised prior data lower. And in fact, every single payroll figure in 2023 has been revised lower and sometimes sharply lower. So every time we've gotten a jobs number, any month of this year, the next month that comes in, they revise the prior numbers lower, which means that the numbers we saw in the prior months of 2023 were actually not correct. So the labor market is substantially weaker than what was reported. So we're really seeing the first signs that the labor market is starting to feel the tightening the Fed has been doing over the past year and a half. The first true signs of that labor force or the labor market really starting to deteriorate. So what's interesting is that these signs have been taken by the market as the classic bad news, good news type of trading style. As we've been getting bad macro numbers, as we've been getting these type of misses in the job market, particularly what we've seen on the JOLTS data, the market jumped almost 2%. It was the best week, I believe, since March, as the market celebrated these bad economic figures and the kind of like the job misses. And it's really interesting to dig into that and why that was the case.
It seems like the market is getting a little prematurely excited about a potential pivot, but nothing about what the Fed has been telling us would indicate that that's the case.
Well, you need to just look at what Powell just said at Jackson Hole, Wyoming. So just in the prior week, Powell went to Jackson, which is where all the central bankers of the world meet once a year. At the end of August, it's a very famous symposium. Last year was, very famous because Powell was unhappy with the market going up and made this very hawkish speech of, why the market should not go up, and caused the market to go down almost 3% that day. So, it's something to pay attention to, because typically when there's types of Fed pivots or Fed moving from one thing to another, it's usually communicated in Jackson Hole. And what he was saying about the labor market is that labor supply has improved, and they're saying that there's less of, the labor market is a little bit less tight. And what they're looking for is for that to continue. So they're looking for evidence that the tightness in the labor market is gone, which means that it would allow monetary policy to slowly ease. So exactly to your point, Powell did make comments to that factor in Jackson, and the market listened, right? So the market is now expecting the Fed to be done, which is, I think, a very high likely possibility. Like, given the data we've seen over the past week or two, I would say that it's more than likely, given what we're seeing in the Fed funds futures here, the Fed is done. I would say currently I would put it about an 80% probability that the Fed, that the hike we saw this past month was in fact the last hike of this cycle. I actually do not believe the Fed will hike again this cycle. I think we're actually done.
Do you think if we're at the terminal rate now, do you buy what he was saying about, keeping things tighter for longer? Because even if it's terminal rate, it doesn't mean we're necessarily close to a pivot.
That's right. That's right. So that's, I think, is going to be a lot determined in kind of the incoming data and how the incoming data looks like. But as you can see by what the Fed funds futures market is pricing in now, they're pricing in a very low chance of one additional hike into the end of the year. But then really what we're pricing in is a lot of rate cuts into next year. In fact, they're saying there's going to be around 125 basis points of cuts into next year, which is very likely going to be due to a recession. I mean, that's kind of what the bond market is telling us right now. And, the market is celebrating that, or at least for now, it's celebrating that because they're seeing the bad data as type of, okay, so that means the Fed is done and it's not hiking anymore. But the biggest question we have to ask is the market actually wrong for wanting the labor market to soften? Like, is the market wrong for wanting the data to go bad? Because right now they're trading this bad news, good news narrative. But the question is that actually the right thing to do based on what we've seen historically?
Well, what's history shown us with previous divergences like this? Where are we going to go? Are we going to go to 01? Are we going to go to 87? Where are you going to take us?
So here I'm taking you to 2005, starting here all the way to 2009. So what's interesting is that you're seeing the JOLTS data in white, and you're seeing the S&P 500 here in orange. So it's actually quite interesting to see how that jobs data of how many open jobs in the economy is incredibly tightly correlated with the stock market, even on some of the shorter time frames. But what's interesting is that the labor market data peaked before the stock market did. So right here around March of 2007, open jobs in the economy started decelerating, but the market only peaked in October. And then, the two were pretty tightly knit, and eventually the market actually bottomed a little bit ahead of when actual jobs bottomed as well. So I don't necessarily know if you want to see a very fast reduction in the number of open jobs in the economy. At least historically, it hasn't gone very well for the stock market. Here you see 2000. So 2000, March 2000 here, into all the way into 2005. So very similar. Stock market mimics quite a bit what the open jobs in the economy do. And then I'll take you to today. This starts in 2018. Here's our peak in 2021, early 2022. So it's interesting. Stock market has been very correlated with the open jobs position all throughout 2022. And now we're seeing one of the largest divergences on record between the total amount of open job positions and the stock market.
It's interesting how in the 2000 or 2001 data you were just showing us, that they peaked actually almost identically. That was interesting. It's quite different as opposed to being a leading indicator. It looks like they experienced the high
together.
Together.
Right.
And a little bit different than where we are right now, I suppose.
Yeah, these two data sets are very tightly knit. And it makes sense because when you really think about it, what drives our economy? What drives our economy is consumption, right? 70% or so of the US economy is driven by consumption and consumer spending. And we need jobs in order to keep that consumption going, right? So if the total amount of job opening is decelerating, that just would mean that less people are going to have jobs and there's less people that are going to be able to buy stuff. So eventually that's going to impact corporate margins, right? So you should see a high correlation between the jobs data and what the stock market is going to do. That's typically normal. So that's why I think that celebrating, a Fed pivot necessarily, all I have to say is be careful what you ask for.
Right. No, it's interesting. And the JOLTS data that we're looking at here, how far back does that measure go?
So different measures, I have it back to 2000, but some other measures have a similar going all the way to 1960. So, what's interesting here is what the market is really celebrating is this idea that the Fed is going to be able to cool the labor market just enough, but it's not going to be too much to cause a recession. And therefore, markets will eventually recover, go up. But when we're looking at the Fed's track record of actually being able to do it, it's quite rare. When you're looking at the 11 attempts over the last 60 years, only 1994 to 95 is officially a successful soft landing, which means that the track record for them to be able to do it is just terrible. And the main reason is once the labor market starts deteriorating, it's kind of like, the snowball is rolling or you're starting a forest fire. It's very difficult to contain once it starts rolling. So yes, it's starting to roll. The Fed is starting to see it. Yes, it's probably going to impact inflation in one way or another and reduce it. But how do you actually know that it's not going to accelerate far beyond what you anticipated? And history shows that that's exactly what happens. Once it gets rolling, it's very difficult to control it and very difficult to know how far it would actually go. And that's kind of one of those things that I would caution, which is exactly goes to careful what you wish for.
Are there any key differences between the conditions in 94 and 95 versus the conditions we're seeing right now?
Yeah, I mean, the debt levels obviously were a lot less, but also there's a couple of interesting things around the early 90s period. First one is this is the era of globalization. So there's this massive force to open borders, free trade after the fall of the Soviet Union, right? So 1991, the fall of the Soviet Union was one of the greatest events, I think, in human history, where a huge number of countries just opened up for trade and investments. And that really fueled a huge growth in the 1990s. So I actually think we're seeing the opposite condition to that. We're seeing deglobalization, we're seeing onshoring, we're seeing more trade wars. So it's almost like the exact opposite of 94, 95. So that was something obviously outside the control of the Fed. But the other one was obviously the internet boom, right? So new technology was also a huge impact where productivity was growing at one of the fastest pace ever, really. With the internet. So these two factors together, I think, contributed more to that soft landing than anything the Fed itself has done. Now, some would argue that AI today is similar to what the .com was, but I think that's very, very early to make that judgment.
Yeah, I tend to agree.
And we don't obviously have the globalization as well. So,
right.
So, when you're looking for that pivot. The thing about it is that usually when the pivot moment actually comes, the economy is just too far gone, right? So the snowball just started rolling already too much. Defaults are starting to come in, too many layoffs, consumer spending is down. And we know that monetary policy just works in a lag. And the lag is usually multi-months. It could be a year, it could be 18 months. It really depends based on the cycle. And when we get these rate cuts, it's usually too late. You need a lot more in order to stop the economy from decelerating. So I just wanted to show you a few of these examples where what actually happens at the moment of the pivot for the Fed funds rate and what happens in the stock market. So in this case, you're seeing the stock market between 2005 and 2011. And here's the Fed fund rate. So interestingly enough, the Fed fund rate reached a term or rate of 525, very similar to today. And then the moment the pivot actually happens and the Fed cuts rates, there was maybe a couple of weeks of a move up, but then what happens? Did the rate cuts help the economy or the stock market? In fact, the stock market bottomed only when rates reached zero. Kind of interesting, right?
Yeah, that's fascinating. It's funny because I remember you saying, you were talking about this as we were beginning the rate hiking cycle. And you were saying, you were like, we're rate hiking. You're like, but the interesting thing is like history has always shown us that you're like the real pain starts when the pivot happens. But at that point, it's like the damage has already rippled throughout the system. It just hasn't been realized yet. It hasn't been recognized because you never know where in the system the weak points lie. And where you might have credit risk or where you might have that credit event. And this time we still don't know, at least at this very moment in time.
Right, which is why there's this famous, sell the last hike type of old trader edge. This one is in 2000. So again, 1999, 2000, 2001 through 2003 here at the bottom. And again, when does the market actually top? It tops before the cuts, actually. It topped after the last hike. So the last hike happens here, and then it just topped while the Fed was just holding rates steady for a while. And then it accelerated down as the Fed was cutting them. Very interesting. And again, the market doesn't bottom until the Fed almost reaches zero.
One thing I'm curious, did you look at what's the average lag from let's say a terminal rate to when the market starts reversing down?
Yeah,
in earnest.
We've looked at that, and actually the 1970s were a little bit of an exception, because in the 1970s things were moving exactly where the rates were, because it was very stagflationary driven era. So that's one caveat to notice. But when we go back to the yield curve inversions, and we talked about it quite a bit, it's anywhere from 6 to 8 to 20 months usually is kind of the lag, and we're month 10, 11 already. So I would say from that moment of the inversion. So I think the clock is ticking. I think a lot of it just has to do whether did we just reach the terminal rate, because typically you reach the terminal rate when the data starts getting pretty bad, and then the Fed is just done. And then typically that is right around when things top out, or historically has been. Here's now, this period of time, this is one of the fastest rate hiking cycles in history. We got to 5.5% here in August, July. Interestingly enough, even here during COVID, markets bottom as the Fed goes to zero. We get this huge COVID boom, and then markets actually did sell off in response to some of the fastest rate hiking cycles, but then kind of recovered. And if this is the terminal rate, or we're around the terminal rate, this is one of those things we're watching very carefully, because just history is telling us this is one of the next 6, 12, 18 months is likely going to be the riskiest period of time when you're looking at these historical parallels.
What I can't understand though is if you're Jay Powell, and historically inflation doesn't come in a single wave, it comes in multiple ones. If we really do start seeing this rapid deceleration and economic indicators are deteriorating, economy, markets start to crash, can you really take it back down to zero? Like if inflation is still 3-4% or higher, can you really keep cutting?
Yeah, I mean that's the $1 trillion question. Some call it the quote Keynesian endgame, which at some point that's what happens. This is why I think this cycle is one of the most interesting ones, because it really remains to be seen what happens with core inflation. I mean, it is possible though that a market crash and a recession does actually stop inflation, right? That is very possible. And if that's the case, the Fed has actually achieved what they wanted to do, and then they're able to cut rates. But the cost of taking out inflation would be a recession. And it's funny that you get all the soft landing calls coming in recently, which is again on par with what we've seen in 2007, 2000, and many other recessions. Usually when that happens. So again, I think the key question right now is, did we already see the last Fed hike? I think the answer is yes. So if that is the case, this is the moment to see how long they keep rates higher, when do they actually start cutting, and how does the incoming data come out? And as I promised you before, something is different this time.
What is it?
The cycle is not exactly the same. Something is quite different this time, and I wanted to flag that because, I believe the markets would have been much weaker if it wasn't for this. And this is actually one of the things that's quite different in this cycle that makes it a little bit more challenging to predict. And really, a big part of it is the megacorp resilience, or just corporate resilience. So what I mean by this, this is one of the more interesting charts I've ever seen, really, on the macro side, which typically what you see is the total amount of net interest payment corporations need to pay. So again, last month we covered the government. And we know the government is now spending near $1 trillion in interest payments, totally unsustainable. But that's the public sector, right? They can do that for a little bit. The private sector cannot, right? So if we get very large interest expense in the private sector, they would need to lay off people faster. So typically what you're seeing is that when rates go up, interest payment corporations pay would go up as well, which just makes sense, right? Especially on the lag. However, this time around, the total net interest that corporations pay post-tax has actually went to an all-time low over the last year as rates have gone up over 5%. Wild.
Well, absolutely. So why is that?
Yeah, it's a great question. So, digging into that, you can actually see that the net interest payment has collapsed over the last year. Like they are actually paying less. And the main reason is right after COVID, we had one of the fastest drops to zero that we've seen right there. Boom, big drop to zero. And all this QE money that was going on, individuals were able to lock mortgages for less than 3%. I think that was one of the best trades ever made. If you're able to get a house and refinance it or buy it, under 3% right after COVID, we see that with individuals. So what you're seeing here is the current mortgage rates in the United States. And here you're seeing the average effective rate on homes today. So, historically, the correlation was very, very strong because the mortgage rate wasn't moving that quickly, right? Now we're seeing one of the fastest changes in mortgage rates ever. And even though the effective mortgage rate is 7.5%, the vast majority of people have it around 3.6. So this is why, for example, the real estate market is not tanking, is because people are just not going to put their homes for sale because they have it at 3.6% rate. And there's literally no incentive to move to 7.5% rate. So the market's frozen. So very similarly, corporations issued bonds right after COVID for very, very low rates and were able to lock in a very large amount of capital at a low rate. And in fact, have been playing the yield curve in reverse. So what was going on is a lot of these mega corporations were able to lock rates pretty low. And what they were doing is taking a lot of that capital that they were getting on the long end and putting it in short-dated treasuries, getting over 5% for it. So one of the craziest things is that mega corporations, the higher rates actually added to 5% of profits last year, if you're looking at the total earnings, versus in a normal cycle, they would have actually lost 10% of earnings. So this is really holding the markets up as they were able to do so.
Yeah, I saw that, there's companies like Apple as an example, where they issued bonds at I want to say it's 2.6% or something like that. So, right. So what you're saying, if I'm understanding it correctly, and please correct me if I'm wrong. So you're saying that they're basically, they borrowed at the long end essentially because they got these 2.6% bonds that are out there and trading. And they ultimately now have enormous amounts of cash and they're depositing that into treasuries and earning 5.5 on the bonds that they sold at 2.6. Is that roughly what you're saying?
That's exactly what's happening. And they have basically played the yield curve in reverse. And that added a ton to the earnings of all the mega corporations that are still sitting on a pile of cash. And, that's caused one of the biggest discrepancies, which I said this time is different because we've never had that before when you're looking at that type of situation. However, what the data is not showing you is that there is an enormous discrepancy between the top 10% of the market and really everybody else, and particularly the bottom 50%. And the biggest difference here is that the bottom does not have access or as liquid of an access to the bond market. So they weren't able to effectively lock these low rates. So if you're looking at the bottom 50% of the S&P today, their effective rate is nowhere near the top 10%. The top 10% still has an effective rate of about 3.5%, but the bottom 50% is already close to 6%, an enormous difference.
So, does that create a situation where we could see a mass extinction event in the long tail of the corporate universe? And it's a kind of scenario where the rich get richer in the largest corporations and the others that weren't able to sell bonds at low rates don't have any financing options. Banks have tightened, like there's nowhere to get capital, and their servicing costs are sky high. And what do you do?
Yeah,
you're backed into a corner.
this is exactly what I'm somewhat worried about. And when we're looking at the interest cover, let's compare the top 10%, right? So the top 10% can cover their interest payment 10x fold or more. But if you're looking at the Russell 2000, that number is barely 2 to 3. And the vast majority of the small companies are the lifeblood of the economy. These mega caps are actually not. As famous as they are, as big as they are, they're not the big providers of jobs, and we'll touch that in a second. But when you're looking at the difference, even between S&P and Russell 2000, you're looking at their access to the bond universe versus term loan, for example. So, bonds, even though in 2024, even for S&P companies, we are going to see a very large spike in interest, and into 2025 even more so. But you can see that Russell companies almost have no access to bonds at all. So it's all going to be other types of revolving credit that are much more susceptible to the short-term rates than some of these S&P companies. So again, to that point, yes, a mass extinction event in smaller companies is completely possible, and which is why I think this crisis could be different, because it could be more focused on smaller companies, like we've seen with the regional banks in March and April, much more focused on smaller companies than, let's say, large companies. But think about, who do small companies do business with at the end of the day? They still do business with big companies, right? So the big companies still need the small companies to survive. So in a way, this crisis can start from the bottom instead of from the top. And we're seeing it already in the data. So when you're looking at July, the bankruptcies have gone up 71% from the prior year. Huge spike in bankruptcies. So what you're seeing here to the left is the total amount of bankruptcy filing. And look at what's going on right now. Look at what's going on right now compared to what we saw in 2020 in COVID, for example. And you can see here 2009. So, total new Chapter 11 filing on quarterly and bankruptcy filing. So those are mirroring each other pretty well. We're seeing a really big spike right now. And what's really interesting too is that the credit spreads are not reflecting that in the real economy. So the credit spreads are primarily impacted by things like, mega caps, and like basically how the market cap is kind of shaping up to be. And what you're seeing here is that, this spike in bankruptcies is not reflected in credit spreads at all, which I think is very material. So it's not surprising then that bankruptcies have actually soared 71% year over year since last July. We'll see how the August data comes in, but it is, very fitting with what we're seeing in the divergence between these mega caps that have access to cheap capital and the ones that do not. So what you're seeing here is the total amount of bankruptcies in the United States. So you see total new Chapter 11 business filing and then bankruptcy filing with this type of lag. So you're seeing here the data going back to 2008, 2009. And look what's going on now into 2023. You're seeing a jump that was the COVID jump. Look at the jump that's going on right now, really going unnoticed, especially given how equity markets typically react to bankruptcy filing quite a bit, and they haven't been this year. And what's interesting is that credit spreads are no longer reflecting that either. So what is the credit spread? It's the spread between the rate you're getting on corporate bonds and the rate you're getting on a 10-year treasury. So that typically reflects stress in the economy. The greater that spread, the more risk in the economy there is, because the more a corporation would pay in order to get access to capital over the treasury rate. So that's been very, very correlated with bankruptcies, which makes sense, right? The corporate sector is more at stress as this number is higher. And you're seeing this jump in bankruptcy filing completely not reflected in corporate credit spreads.
So why would that be?
I think a lot of it has to do with the mega cap situation. So because mega caps are not stressed and because they become such a large percentage of the index, I think there's a good chance that this is a good explanation of why that's not happening. But there could also just be I'm not entirely sure. Like, I think this is my simplest explanation. But there just could be this lag effect that it may kick in any moment. And what's really interesting is that, credit spreads here in white are very correlated with the VIX. And it would make sense because it's the one layer before equities, right? So equity risk, and then you have the credit risk on top of it. And you're seeing when the credit risk spikes, equity risk spikes as well. And they're very, very tightly correlated. So we know that if credit spreads rise, VIX rises as well, which leads to a lot of volatility for equities and potentially downside pressure. So if we're assuming that this is going to happen, there could be a pretty large spike in volatility in financial markets, call it in the next few months, if that correlation is to continue and if credit spreads actually start widening again. So one of the interesting things I found there.
And reminder for those, the VIX is a measure of volatility in the markets. And so as you can see, like we've had this period of relatively low volatility. But the question here is, how long will that last?
That's right. And what we know already is that credit conditions for those without access to the bond market is pretty bad. When you're looking at smaller companies, let's say the ones with less than 100 employees are the lifeblood of the US economy. And they actually account for 2/3 of all the recent jobs growth. So what you're seeing in this indicator is how easy or tight credit conditions are for smaller businesses. And they're getting pretty tight. So what you're seeing here is, this is the 2008 spike. This is late 90s. This is COVID. Then things got very, very easy right after COVID. Into 21, it was actually some of the easiest credit conditions in history. Some would argue sparked the almost a bubble-like conditions. And today, they're getting very, very tight. So again, we're in a world that, when I said this time is different, yes, it is different because it's almost like two different sets of conditions for two different sets of companies. If you're a mega cap, things are quite fine. But if you're anybody else, things are getting pretty bad.
Got it.
And we see that in the data too, where companies that are, up to 100 people are accounting for a very large amount of job growth. Cumulative share of net change is quite high. So again, almost 2/3 of job creation was in the smaller companies. So if smaller companies are getting squeezed right now, and we believe they are, I think that's going to create further challenges in the job market in the months ahead. So what we've seen up until now, the drop in JOLTS, non-farm payroll, increase in the unemployment rate, all of that is likely to continue into the next few months. This is likely actually just the start. And this mega cap situation may explain the difference that we've seen here between the S&P 500 in blue and the Russell 2000 here in white. And what you're seeing is, the Russell 2000 is barely even up for the year. Despite all this run in the S&P 500, the small cap index didn't even exceed its February high here, February 2023 high. It's actually quite lower as the rest of the market continues higher. We've actually never seen that type of divergence. The only time we've seen something similar was right before the dot-com bubble busted. And a few companies in the tech sector was leading the economy higher into 1999, and small caps were not participating. But this I believe, is one of the largest divergences since then. And I think the reason is not necessarily the AI mania. I think that's one of the factors for sure. And AI came out, we talked about it extensively, came out maybe in March, April. The market started trending up with the Magnificent Seven. But I think a bigger factor than AI is actually the access to capital and debt. It actually explained in a way that, yeah, they're playing the yield curve in reverse. Their earnings are actually going up because they borrowed so much money at cheap rates, and they're able to let it sit at 5% treasury rates and actually increasing their earnings, while the rest of the market was just unable to do that.
Yeah, that's really interesting because it goes against the narrative. We were looking for explanations. That this one actually makes a little bit more sense, but it also goes back to one of the things we've been talking about. One of the core themes is that, yes, the rich get richer, and there's this, concentration effect that's taking place in the S&P 500. But one of the risks then is that, as the concentration grows and grows and grows, that means that a reversal will be that much more severe. Is that right?
That's exactly right. Because a healthy market is a market where most companies participate, everybody's doing okay, people are hiring, there's a lot of, creativity and general wealth is being created. It's not so healthy when 7 companies are basically the ones driving the indexes and the rest of the market struggles in this way that you're seeing here, and being challenged, being squeezed by rates, etc. So it's really going to be interesting to see. But at the end of the day, too, remember, even these mega caps need customers, and a lot of the business they do and who they sell to are the smaller companies nonetheless, right? So at some point, this is going to impact them as well.
Yeah, it's an ecosystem. And if the ecosystem is hurting, everyone's going to pay the price.
Right. So lastly, I want to talk about GDP and leading economic indicators. We spoke about this. We're seeing the LEI really collapse over the last few months. July was kind of a flattish month, maybe slightly up from the lows. And GDP has been revised up. Year-over-year GDP change actually came out at 2.1%, was expected 2.4%. Again, slightly lower than expected, but still positive GDP. And one of the questions I've been asked is, why isn't GDP decelerating more? And it is quite interesting because when you're looking at the LEIs, they still are looking very negative, and they were negative or neutral in July as well. And LEI continues to signal recession ahead. We're below the recession signal. And one of the things I was looking for is, why isn't GDP following LEI faster, as it should? And one of the interesting things is that when you're looking at not necessarily the gross domestic product, so sums of all goods and services produced in the economy, you're looking at the gross domestic income, which is the total amount of income in the economy. That is actually turning negative and dropping quite fast. Those two are very correlated, but the gross domestic income is leading GDP quite a bit. And you can see right now that the spread between the two is the widest it's ever been. So this goes back to 1950. There's never been such a big spread between domestic income and domestic growth. And look at the other periods of time when this type of spread was so wide, right there. And this is 2006, 2007. And you see here that gross domestic income collapsed right around 2007. And then look at that, GDP followed just shortly thereafter. And in fact, other periods of time that I looked at the data set were ahead of recessions as well. So something to look at, looking at gross domestic income versus gross GDP, and how that kind of settles out.
So where does that leave us?
So that leaves us with the latest data for GNI turning negative. So another indication, people are talking about a soft landing. We continue to see the data pointing towards a hard landing. In fact, we are more confident in our hard landing call just because the data has been getting worse. I think it is interesting to see how things actually land, with the Fed pivot, whether or not this was the last rate hike or not. But what I would leave people is, careful what you wish for, right? Everybody wishes for the Fed pivot and rate cuts, but history shows that that's actually, not necessarily a good thing. So I think it's one of the most interesting times we've been to in a really long period of time. But in really the last 5 years have been, right? From the reaction to COVID, the money printing, the inflation we're seeing, the macro environment is going to continue to stay challenging. I think it's going to continue to stay volatile. And, being well diversified and not sharing as much correlation, I think is one of the best things you could do as an investor.
Right. And I think a lot of intelligent investors are asking themselves the question, okay, if, I thought indexes were a way to diversify, but if indexes themselves are no longer diversified, what's an investor to do in this environment?
Well, if by diversifying you mean you own Apple and Nvidia, then yeah, basically that's that's what the index has come down to. So again, and you're looking, okay, I'm going to own the stock market, I'm going to own the Russell 2000, but then you're seeing like the Russell itself is having a lot of issues because they're actually getting squeezed. So it is interesting that owning the mega caps was the right strategy in 2023, but it's very easy to say that in hindsight because it was very difficult to predict this dynamic that caused it to happen. But going forward, I think things are going to be far more challenging given where we've been with the yield curve inversion, all these macro indicators we're seeing, and what historically happens after a Fed pivot. So I'll just want to remind everyone that, history is not at the side of the Fed being able to successfully do a soft landing, which is something that we watch for more than whatever pundit decides to say about a soft landing opinion today. And we continue to look at the data. And again, if the data improves, if things look different, if the Fed does manage to create a soft landing, I'm not saying it's impossible. All I'm saying is we believe it's pretty unlikely.
Right. And when you think about, what you would imagine as a successful portfolio entering into this crisis, we're not encouraging people to trade on this type of information, right? Because it's much healthier to set, a portfolio allocation that you can live with and sort of hold through various crises. What do you think that actually looks like?
Yeah. So, at the end of the day, it's all about the efficient frontier and the way you think about it, right? So when you add non-correlated assets, that's the closest thing you can get to a free lunch. The more uncorrelated assets you have, the smoother your portfolio and the more your right looks like this and less like this. So, adding these types of non-correlated assets is the best thing you could do, especially if you're a long-term holder. Also, bonds are probably the most attractive they've been in decades, especially given that they're yielding so much more than the dividend yields on the stock market. Now, I'm not going to tell people they should speculate and try to short the market or something like that. There are specific instruments. We have an instrument that does that, when obviously it's not a tail fund, but as we see this type of environment, that's the bet we're taking today. Obviously, that's not the bet we would take if the data was changing. But I would say that, having an allocation to bonds would be a really good idea. You're getting paid to wait. Having alternatives is a great idea as you have less correlation. And obviously, some people are long-term holders of equities. I wouldn't necessarily buy myself here, but I understand why people will hold an index for 5, 10, 20 years and dollar cost average. That's obviously always been a good strategy, but it has to be married with a variety of other uncorrelated assets, in my opinion, in order to create a more efficient portfolio. Also, it may be time to buy intermediate term bonds and some longer duration bonds, not just short-term treasuries. History shows that when the Fed pivot does happen, long-term bonds tend to perform very well.
Great. Well, let's finish on that note then. Until we talk next, let's see what markets have in store for us, and wishing everybody a great start to the fall.